You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
All right, everybody, that music means it's time once again for Options Insider Radio, the interview program here on the old network where we welcome on guests from throughout the world of options and derivatives and proceed to pick their brains for the benefit of you, the listener. My name is Mark Longo from the aforementioned network, as well as, of course, from theoptionsinsider.com. And I'm pleased to welcome on a great new guest to the program. He's actually a newcomer to the network. It's hard to believe we've never had him on before. He is Dr. Richard Sandor. You probably have heard that name. He's been around the space for a while and done a few things, probably early on when he started with the Board of Trade. He was a chief economist, of course, making a lot of developments and research over there. That paved the way for what we know today as much of our interest rate futures market. Many people dub him the father of rates and financial futures in that area. Of course, he didn't stop there. Back in 2003, he moved on to another interesting segment of the markets, the climate markets, and created the Chicago Climate Exchange, European Climate Exchange, amongst others. People have dubbed him these days the father of the climate markets as well, or the carbon markets. So he's been very busy fostering a lot of markets, but he hasn't stopped there. No, of course, 2 years ago, he launched a new venture in a new arena similar to his initial forays. This is the American Financial Exchange. Dr. Sandor, it is a pleasure to have you on the program. Welcome to Options Insider Radio.
Thank you. It's great to be here with you.
Well, I suppose we'll start with your most recent venture because it is top of mind for a lot of us here. Tell us all about this American Financial Exchange. What is it? What made you decide? You know, you've had a pretty good run. You didn't need to go out and start yet another new venture, but you did. What made you decide that we needed to launch the American Financial Exchange 2 years ago?
Well, we're, as you indicated, Mark, serial inventors and serial entrepreneurs. And so after we sold the Chicago Climate Exchange to ICE in 2010, we reestablished the incubator for that exchange. And in about 2011 or 12, we read in a small newspaper that people were questioning the viability of LIBOR. And so I called the team in together, excuse me, and we said, look, it's really strange. London has LIBOR, Europe has Euribor, there's no American interest rate. And I think we're going to need one, and we're going to need to serve the 6,000 small banks that are using a benchmark that really is viable for big banks or may not become viable. And so we went to work, developed some algorithms, got a patent for a new interest rate benchmark. And then after that, we incorporated a new exchange, the American Financial Exchange. And then we partnered partnered with the Cboe, who we thought would be excellent partners, and Cboe, as it is now known, were perfect for us because we wanted to establish a central market that was third-party regulated and transparent, in which small to intermediate-sized banks could borrow and lend from each other. We faced a lot of big challenges because people said interest rates are zero, there's no need, number one, and number two, there's no need for an alternative benchmark. And we got on a plane, went to 125 small to intermediate-sized banks, and said, we're early, but you have to be early to be on time. And we subsequently launched the exchange about 2 years ago. We had 6 members. We were doing $10 to $15 million a day. And we put out a press release in December that we'd passed 100 billion in volume. The 6 banks has grown to 63 banks in the last 2 years. Plus, we have broker-dealers, FCMs, hedge funds, private equity, BDCs as members, 9 of those. So we have 72 members. And the volume went from 15 million a day to 350 million a day in December.
Well, congratulations on an excellent opening 2 years. You already kind of answered one of my initial questions. I was very curious. I had a bit of a chicken and the egg question. I was curious if AFX was born out of the LIBOR scandals, or was this kind of percolating in your brain for a while, and when the LIBOR scandals came along, it was a bit of a happy accident that drove some interest?
Well, we actually thought that over the long run, LIBOR would not be viable, particularly for small and intermediate. So we did that because we saw a small article in the Financial Times saying that people were questioning the integrity of the benchmark. But we were committed not because we had questions about the integrity of the index. We were committed because we thought that the world needed an American interest rate, and one that was determined by transactions, not by polling people. And we thought we could build a better mousetrap, and we thought that interest rates would not be zero. So I think both, we launched the exchange exactly when the Fed raised interest rates the first time, so we were granted fortuity based on our 3 years of private research. And after the exchange got started, LIBOR started getting investigated, and so, people said, there's another benchmark out there. So we published that benchmark. It's on www.Ameribor.net. And our next stage is, as the data gets out there, and as we continue to make penetration, to get an Ameribor-based commercial loan, an Ameribor swap, and then with our partners list futures, options, and ETFs.
Options. Now you're speaking my language, Richard. But before we get to that, you're right. It does sound like you had some auspicious timing in the launching of this venture. Of course, you launched it right around the heat of the LIBOR scandals. Of course, you also launched it when the Fed was just beginning to ignite a little bit more of a fire in the rates complex. I don't think it's too extreme to say the rates complex for pretty much the decade prior to that was kind of a dead area. Not a lot of action going on there, at least for the better part of the half decade preceding it. The amount of interest, the amount of questions we got on this network over that time in all things rates derivatives was probably count them on 2 hands. So it wasn't exactly a hot area, but all of a sudden Miss Yellen and her team started kicking things into high gear. A LIBOR scandal happened. So you had a nice confluence of events around the launch of AFX there, Richard.
Yeah, and my experience has been, and you remember the industry, to be on time, you have to be early. And we recognize that with financial futures, number one. And when we started trying to promote these in the early 70s, we heard the same kinds of objections that we heard about carbon and that we heard about Ameribor. In 72 was, hey, interest rates are not volatile, financial futures is a dumb idea, go back to Chicago, there's no need to hedge, etc. And when we introduced financial futures, we, by dint of the CFTC providing a regulatory framework, we had to work on legislation that would grant financial futures a home. We had to educate people, etc. But they think it was automatically launched by the Board of Trade in 75, but it had undergone 5 years of research. In the climate exchange, we had given a paper in 92 in Rio, worked on that for 5 years. Then, of course, we got the benefit of Europe establishing a cap and trade market. We were first there, but we worked for 5 or 10 years anticipating a long-term structural change. We did the same thing with the American Financial Exchange, starting research in 11, launching, at the end of 15, again, a 5-10 year kind of cycle. So I think that, there are numerous headwinds to the development of new markets. But if you've gotten a structural trend right, and you understand that there is a latent, not overt, a latent need for a market, that's to be expected. And so we just duplicated what we knew how to do for 40 years and just pulled the lever and did it again.
And Richard, you mentioned in the subsequent 2 years since launching AFX, you've really expanded the liquidity providing pool over there, for lack of a better term. You have your traditional trading firms, but you also added broker dealers, business development corporations, hedge funds, the FCMs, insurance companies. You even have private equity firms here providing liquidity. That one really struck me as interesting. Do you have a lot of private equity firms acting as liquidity providers over there at AFX these days, Richard?
We don't discuss our members other than to say the categories that they fall into. So we have confidentiality agreements with all of our banks as well as non-bank members. We even have HFTs in Chicago as members. So it's really more the category than it is specifically, but the exchange and the reason we get all of these non-bank members is you can lend money on our exchange to high quality banks like MB and Associated, and these are people who've made their membership known, Frost Bank, high quality people, and get better rates of return and with no increase in risk relative to commercial paper, money market funds, etc. And on a risk-adjusted basis, our non-bank lenders feel that the yield pickup is very significant and want to participate. So, we started focusing on non-bank members, and we're actively marketing to hedge funds, to private equity, to BDCs, to anybody who's got cash management issues, and where our rates on a risk-adjusted basis, in their opinion, are better than their current cash management.
Interesting, as we all know, the liquidity providing class, the community in the derivatives world has been under siege for years, so it certainly makes sense why you would go outside the traditional pool, particularly for your product category. You can expand the pool to a lot of other firms that probably don't play in the traditional products. So you mentioned earlier, Richard, something I want to go back to. You mentioned your relationship with the Cboe at AFX. What exactly is that relationship? Are they just investors, just a technology provider to you, or is it more of a true joint venture with the Cboe, the AFX?
No, they are all of the above. They run our software and upgrade it. They serve as the compliance provider. They ensure that the market has integrity. We have non-spoofing rules. Obviously, we guard against undue price influence. So they serve the role as running the platform for AFX, being our compliance folks, and are an investor. So we have a comprehensive relationship. As you well know, they're very innovative, and they've been great partners for us.
And how did all that come about? Did you approach them with the idea and they were just receptive from the bat? Or as you were doing your tours of small banks, were you also doing your tours of various exchange partners because you knew you needed someone to provide the infrastructure for AFX, and Cboe was really the first to see the merits of what you were working on?
Yeah, the Cboe really saw the merits of what we were working on. It's a different asset class for them, interest rates. So it made diversification, and I've known them since I was chief economist, and they were born when Joe Sullivan moved over from the Board of Trade to become the first CEO for the Cboe. So we had a pretty long-term relationship, so it was a natural, and I knew the leadership well, and they knew me and thought I wasn't too bad and that I'd make a good partner.
Well, it's been an interesting conversation. We talked birth of Ameribor. We talked, of course, the early 2 years here for AFX and all of the growth that you're seeing on the platform in terms of volume, in terms of value being traded on the exchange, in terms of the growth of the different liquidity providers coming on to the pool, talking about, the structure of the entity itself. That said, what can we expect? What's on the horizon here for AFX in 2018?
Oh, I think what's exciting, and it's important to get the story out there about our success has to be told, and that's why I really appreciate this interview. And people have to understand when we say that we trade $350 million, that ultimately, that's real money. That's not margined. It's not notional. It's $350 million changes hands, not a fraction of that. Our next step is to really expand into the derivatives area, and as our volume does, we'll talk about that. So I think it's just continued growth, and we have a strategy. We're executing it. We're gaining credibility. We will be holding conferences. We will be educating academics. We will be looking to actually implement, and the big surprise is going to come somewhere, I hope in the first 6 months of the year, where people start adopting Ameribor as a benchmark for commercial and industrial loans.
Well, Richard, you got me excited on all those efforts, particularly for the hopefully forthcoming launch of options and futures on all of your products. We'll definitely have to bring you back on to talk about those. But before we wrap up, Richard, I'd be remiss if I didn't ask you about this. I know we have a lot of our listeners out there who are very familiar with your other recent endeavor, of course, the Chicago Climate Exchange and all of your many efforts in the climate markets. Of course, you launched that in the early 2000s, I believe 2003, all the way up until the sale in 2010. I'm curious now, looking back on it, we obviously have a little bit of hindsight with those early days of the climate markets. In fact, you even wrote a book last year called How I Saw It about this very topic. I'm curious if you could share a little bit with our listeners some of your thoughts on how the early days of that market played out, and maybe really your thoughts on all the way up to the sale of ICE. Was that kind of what you intended all along, or what are your thoughts on how those early days of that market really played out?
Let me, before I answer that question about the early days of CCX, but let me follow on. I have another book coming out, which your listeners might find of interest. It's called Electronic Trading and the Blockchain. And it'll be published by World Scientific Press. And I did some research in 1970 on electronic trading. And I tell a story of the adoption of that and how it was tied to academic research. I've got Don Wilson of DRW talking about the transition from open outcry to electronic trading, and I've got a best-selling New York Times author, Don Tapscott, talking about the blockchain, and it'll come out at the end of the first quarter, and it talks about what we think is the big revolution that's next, and that's the blockchain, the underlying technology in a post-trade world of settlement. So cryptocurrencies are the tip of the iceberg. The blockchain and what it promises for clearing and settlement and all kinds of things. We also mention in the book that there are fantastic opportunities in the environmental space, where people's footprints and carbon measurement and metrics are all possible. And so we're coming to the point today where when we launched the exchange, nobody said there would ever be any way that we could launch a market without any federal laws. And we managed to get Ford and DuPont and IBM and Intel and 25% of the power companies in America across every sector. And it was member by member. And it was essentially a group of dedicated my team at CCX, and we eventually spread it worldwide. But it wasn't easy. And one of the hypotheses that we say, economists often describe markets, and they say, let us assume there's a market for widgets. In my opinion, it takes a decade to build it, and even longer. And one has to realize you have to develop accounting frameworks, legal frameworks, establish exchanges, get regulatory approval. Academics have to be convinced of the value of it. And starting a market is not just simply opening your doors and say you can buy and sell. So those days were hard. There were big disappointments. There were days in which we traded little or no volume. And they have to be built, and all of these constituents have to be educated. And I know it looks easy now, but take a look at, imagine you're in the 1970s. Chicago is a backwater. It's a grain trading town. It births the first equity derivatives. And imagine educating the SEC, then getting regulatory approvals and who could buy and sell these, who could short these, could pension funds operate, or forward 3 years later, it births financial futures. Imagine who could use it. What are the hedging requirements? What about banks? Are they conforming to it? And then fast forward to the climate exchange, the same set of circumstances, and then fast forward to AFX. Markets are complex webs that require knowledge in economics, in trading, in software, in regulatory affairs, in accounting, and so much about Chicago and what's developed is quite or not as understood as it should be among academicians or regulators. So it's quite remarkable that this city, is a leader worldwide, but it didn't just happen.
Oh, there's a lot to unpack there. But you actually got to one of the things I was planning on wrapping up with, which is little birdie had been whispering to me that you were indeed interested in all things crypto and blockchain. I didn't realize you had a new book coming out in Q1. That's certainly fascinating. I think a lot of our listeners will be interested in that. I was referring more to your recent patent filings out there in the crypto space. So is it safe to say, and it certainly sounds like with the book and this venture, obviously professionally, your focus is on AFX, but maybe personally, is it safe to say that the future holds a lot of crypto and or blockchain in store for Richard Sandor in the coming years?
I think it's safe to say that.
And just really quickly, since everyone's going to be screaming this at their device when we're having the show and listening to this, what are your current thoughts really quickly on, obviously we have, I think it's charitable to call a bit of a bubble now in all these various currencies. Does that concern you? Does that interest you? Does that show maybe there's an opportunity here? Or perhaps is it something you're worried by the time this bubble, if it does indeed burst, would that hurt the interest in crypto and indeed the underlying technology, the blockchain going forward?
I think that the big change is going to come. The forward to the book is written by Blythe Masters, who ran the commodity business at J.P. Morgan. She is now the CEO of Digital Asset Holdings. I think it's publicly knowledgeable that she's working on blockchain in Australia. We just have to recognize that the ups and downs of the cryptocurrency, I think, are not relevant relative to the blockchain. You've got Ethereum being used in cat bonds that are traded on a blockchain network. The applications in medicine, the applications to exchanges, they go well beyond finance. And of course, there will be confusion if the price drops, but I am unambiguously convinced the technology will be a game changer as much as the internet was and as much as electronic trading was.
Well, Richard, this has certainly been a fascinating conversation. I appreciate you taking some time with us today here on the network. And we're looking forward to how all of these initiatives play out, the forthcoming derivatives over there at AFX, as well as, of course, all of your blockchain and crypto initiatives in there. We'll be looking forward. I'll have to bring you back on again down the road in, let's say, 6 months or so, Richard, so we can see how all of these initiatives are playing out in the marketplace.
Thank you very much. I appreciate it, and good luck, and a very happy new year to you and the listeners.
All right, and that's going to do it for this episode of Options Insider Radio. But stay tuned to the network. We'll be back with more shows very soon.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.